Welcome to The Explainer. Today we're taking a deep dive into the latest financial report from Versalink, a big name in office furniture. And let me tell you, the headline numbers they look pretty alarming. So we're going to peel back the layers and figure out what is really going on.
So right out of the gate, the report just hits you with this jaw-dropping number. The company's net loss hasn't just gone up a little bit. It's absolutely ballooned by over 100% compared to the same time last year. For anyone watching the stock, a number like that is a huge flashing red light.
But here's the thing. A big, scary number like that almost never tells you the whole story. Is this a sign that the company is in a total freefall? Or are there some very specific, maybe even one-off things going on under the hood? Well, that's exactly what we're here to find out. Let's start the investigation.
Okay, so the most logical place to start, right? When profits take a nosedive, you got to look at revenue. Did sales just fall off a cliff? Let's check out the top line.
And here's our first real surprise. Total revenue didn't crash and burn. In fact, it only dipped by about 5.2%. And when you look closer, you see two completely different stories playing out. Their domestic sales, right there in Malaysia, actually grew. They went from around 10.4 million ringgit to over 11 million. That's a really healthy sign for their home turf.
So the issue isn't at home. The real drag on their performance is coming squarely from their export business. You can see sales took a pretty significant hit there. So that leads to the next question. Where in the world did those sales go?
Looking back at last year's numbers, it's crystal clear just how massive North America was for them. I mean, look at that slice. It was a huge chunk of their export sales, bringing in almost 4.2 million ringgit. This wasn't just another market. It was a cornerstone of their whole international strategy.
And wow, this visual just says it all, doesn't it? This is the heart of the revenue problem. In just 1 year, that huge piece of the pie has shrunk dramatically. Sales to North America were pretty much cut in half, dropping all the way to 2.3 million. The report hints that things like global uncertainty and, trade tariffs are the likely culprits here.
But hang on a second. A 5% dip in revenue, even with that big drop in exports, that just doesn't add up to a loss that's over 100% bigger. No way. So to find the other pieces of this puzzle, we have to look past the sales numbers and start digging into the company's costs.
And there it is. This is our first major clue. Their administrative expenses, the day-to-day costs of just keeping the lights on, they shot up by a staggering 59.4%. An increase that big is almost never just a routine thing. Something major had to have happened.
And we found it. Buried in the financial notes, you find the main reason. A single, large, one-off event. It turns out the company had to give back 1.2 million ringgit as a partial refund on a property deal from a couple of years ago because some conditions weren't met. I mean, that one item alone accounts for a massive chunk of that increased loss.
Okay, so the second big hit came from their gross profit margin. The easiest way to think about this is it's the profit the company makes on every single thing it sells, before you even factor in those administrative costs. And you can see that margin got squeezed, dropping from a pretty healthy 28% all the way down to 24.5%.
So what caused that squeeze? Well, the report points a finger at another very specific event, a write-off of more than 500,000 ringgit in finished goods. In plain English, that means a bunch of their inventory, their already built furniture, had to be taken off the books as a loss, maybe because it was defective or just couldn't be sold, and that directly eats away at your profits.
Okay, let's recap. We've got falling export sales, a huge one-off administrative cost, and shrinking profit margins. You'd be totally forgiven for thinking that the company's bank account must be hemorrhaging cash, right? But this is where the story takes a really unexpected turn.
And this is the paradox right at the center of this entire report. On the one hand, their income statement shows a net loss of over 4 million ringgit. But on the other hand, their cash flow statement shows they actually generated nearly 1.5 million ringgit in positive cash from their actual business operations during the exact same period.
So how on earth does that work? Seriously, how can you be losing millions on paper but still have cash coming in the door? It feels totally counterintuitive, but it all comes down to a really important difference between an accounting profit and actual physical cash in the bank.
It really boils down to two key things. First, accountants have to add back what are called non-cash expenses. The biggest one here is depreciation, over 1 million ringgit. It counts as an expense on paper, but no actual money left the building. And second, they were really smart with their working capital.
They brought in $1.4 million in cash just by selling inventory they already had on hand and doing a good job collecting payments that customers owed them.
So here's the bottom line. That really scary headline loss, it wasn't because the business is fundamentally broken. It was caused by a perfect storm of a slump in one key export market and two pretty significant one-off costs. Now that we've diagnosed the problem, the big question is, what does the future hold for Versalink?
Well, the road ahead is definitely not going to be easy. I mean, look at this list. The company's dealing with a super tough global environment. You've got everything from economic uncertainty and geopolitical conflicts to the U.S. tariffs that are hammering their main export market, and of course, rising shipping costs because of disruptions in places like the Red Sea.
But they're not just sitting back and taking it. Management has laid out a pretty clear game plan. They're going to focus on what they can control. That means tightening their belts with cost controls, trying to make production more efficient, and actively looking for new markets so they're not so reliant on North America. They're even looking to diversify and bring in some new investment.
And this is a quote straight from the board's report. To me, this signals that they know exactly what challenges they're up against, and they're committed to being flexible and proactive. They're not just hoping for the best, they're planning to navigate their way through the storm.
Which really just leaves us with one final critical question. The internal problems that caused this period's big loss, those one-off costs, they seem to be dealt with. But with so many powerful external forces pushing against them, will these internal strategies be enough to actually turn the ship around? That, right there, is the multi-million-dollar question.